According to Este, the following difficulties usually arise in the way of an effective discount policy in expansion. During high prosperity, the demand for credit by businessmen may be interest inelastic. The rising of bank rate and consequent rise in the market rates of interest may attract loanable funds from the financial intermediaries in the money market and assist in counteracting undesired effects. The velocity of its circulation is not directly under the influence of banks. Banking policy may determine how much credit there should be, but it is the trade which decides how much and how fast it will be used. Thus, if the velocity of the movement is contrary to the volume of credit, banking policy will be rendered ineffective. Open market operations. Any of the purchases and sales of government securities and sometimes commercial paper by the central banking authority for the purpose of regulating the money supply and credit conditions on a continuous basis. However, because of the need to maintain the government securities market, the central bank is completely free to sell government securities when and in what amounts it wishes in order to influence commercial banks' reverse position. Thus, when a large public debt is outstanding, by expanding the securities market, monetary policy and management of the public debt become inseparably intertwined. Reserve ratios. Reserve ratio is key to understanding how much credit money banks can make by lending out deposits. Their immediate effect is to alter the liquidity position in the banking system. When the cash reserve ratio is raised, commercial banks find their existing level of cash reserves inadequate to cover deposits and have to raise funds by disposing liquid assets in the monetary market. The reverse will be the case when the reserve ratio is lowered. Thus, changes in the reserve ratios can influence directly the cash volume and the lending capacity of the banks.